Really surprised about what the Fed did do in terms of hiking 25 basis points, really trying to thread the needle here between wanting to instill confidence that what they've done to preserve the banking system is going to work, and they feel good about the resiliency of the banking system, also wanting to be attentive to higher inflation risks. I think in trying to balance which they were more concerned about, financial stability versus inflation risks, to me what came across is that they're still pretty concerned about inflation. I thought what was interesting about the dot plot is that, yes, that median rate in terms of the terminal rate for this year is still at 5.1%. But now you only have one person thinking the current stance of monetary policy is appropriate in terms of a pause. You have 10 people thinking, OK, one more rate hike, whether that comes in May or later on is up for debate. But you still had 7 people, same as December, thinking that you have to go higher than 5.1. And in fact, you saw a couple people even move higher in their dots versus December. So this is probably still a Fed that has a bias towards hiking, wants to hike. I'm just not sure that's actually necessary given some of the data that we've seen.
I was going to ask you about that if you think it's necessary, because we also are likely in the coming months to see a little bit of a statistical pull lower on the reported inflation numbers, right? We're going to be on the annual numbers. And you just wonder if that's something that can kick in that maybe is going to make them a little bit less concerned about inflation.
For a period of time, you're going to see that tick lower. Then actually in the back half of the year, the comps will become less favorable once more. But I think the reality is, if you look at the different data that we've gotten over the last couple of weeks, CPI, 70% of that increase came from shelter, which the Fed has acknowledged is lagging. It's not their biggest area of concern. When you look at wage growth, it did roll over. And moreover, you've seen that inflation has continued to erode wages for 23 months in a row. So it's not that consumers have this massive firepower in terms of consumption. And when you look at inflation expectations, if you look at the Fed survey, if you look at University of Michigan, on both counts, you're seeing that expectations for 1 year ahead inflation is the lowest since spring of 2021. Now, you fold in financial conditions, which have tightened more sharply in the last week or two, and that has the recipes there for a Fed pause. You know, again, irrespective of some of the banking issues that we've seen.
Yeah, a lot of focus on what Powell had to say about the anticipated effects of this credit tightening. How impactful do you think it's going to be? He said maybe it has been worth or will be worth one tightening move.
Potentially.
And Mira, what's the speed of it, if you don't mind? Like, how fast does something like what we've just been through over the last 2 weeks and the aftermath work its way through the system to where we see it in the data?
Let's recognize the fact that credit conditions have already been tightening when you look at lending standards. So the recent lending standard survey that came out showed a pretty dramatic amount of tightening, and that was before a lot of these banking issues. So I do think that that can feed in potentially faster than we think. I don't think that the Fed should wait to see that that has gone a little bit too far. So it's the financial conditions, it's the tightening of lending standards that we've already seen from existing rate hikes that I think is already starting to work its way into the system and will continue to do so.
What does that mean for you as an investor? I mean, essentially, do you feel as if we're kind of narrowing onto this path to a recession? I mean, essentially, it seems to be building in that direction if you bring the lending standards tightening into this, as well as what the yield curve has been saying, the fixed income volatility, and all the rest.
We've been of the opinion that we're headed towards a mild recession. What we've seen over the last 2 weeks heightens that risk and potentially pulls that timeline a little bit forward, because when you see that tightening in credit conditions, that's going to mean that's going to have a knock-on impact to consumers and businesses seeing a little bit less loans, seeing a little bit less spending. So I would say that the recession risks are still present. We've seen that really hot data in January give way to much softer data in February. We would have been talking about that a lot more had other things not happened over the last 2 weeks. So as an investor, I think we want to make sure we're bridging that underweight that we've had for years in bonds. Even though yields have come down a little bit over the last couple of weeks, they're still at very attractive entry points for income and protection from a potential recession. Still want to gear high quality, and I think in this environment, security selection is more important than sector or style, when it comes to the equity market. So I would certainly say that bond market is the place to be right now when we think about some of the benefits there potentially.